Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Turn out the lights, the party's almost over, and all good things must come to an end. Folks, what are you going to do when the T-bill and chill trade is over? For you yield junkies, that's a hard habit to break. Are you going to go cold turkey? Or are you just going to accept lower yields? What's the plan? Just wondering. And whatever happened to I have a dream? Judge not by the content, by your content. Well, now DEI is going to be DEIE. Diversity, equity, inclusion, and now belonging. We want you to belong as well. Okay? So I think DEI is going to be turned into a big regulatory LGBTQ, alphabet soup. How about we just go back to basics and just judge people by the content of their character, not the color of their skin or their sexual persuasion? Just an idea. Then we don't have to have all these other rules or special groups. Just an idea. Anyway, 45% capital gains, really? Really? And taxes on unrealized gains? Either one of those would crush the economy. Both would be a disaster. But folks, let's talk honestly. Let's talk about this really high capital gains rate on billionaires, and especially this extra wealth tax. They're talking about a wealth tax where they're going to start charging the uber wealthy. Folks, the uber wealthy are these people's puppet masters. The politicians are the puppets. You think they're going to let you cut their estate in half? Really? They have what's called family foundations. The Bill and Melinda Gates. What's his name? Gates. Bill Gates. Bill and Melinda Gates Family Foundation. Warren Buffett Family Foundation. They've got a real clever way where if they just give 5% of the principal away to charities, qualified charities every year, it's all tax-free. And it never gets cut in half because it's not technically in their name, but the family controls it in perpetuity. So they're not, because it's not titled in their name. They also structure their income so it's very low. So it's just a big lie. And you, the silly American taxpayer, are the patsy. Don't listen to it. It's all smoke and mirrors. We've got to stop this class warfare, this race warfare. It won't work. And we need to come together as adults and discuss our problems. I'm not that confident, but let me just explain this wealth tax, just so you understand how colossally, incredibly stupid. It's almost as bad as price fixing. Well, it is as bad as price fixing. But here's the thing. If you've got a $100 million real estate deal or a private equity, whatever it is, remember, Amazon, Apple, all of those companies, Tesla, the Green New Deal, all your green stocks, they all started as private equity and private placements. But you got $100 billion in a private deal in real estate. It appreciates 30% in a year. You got a $30 million unrealized capital gains. You don't have any cash flow to pay for it. They're going to tax you on that. Here's a question. What happens if it goes down next year? Goes back to 100. Now you pay tax on phantom income that was never, or gains, capital, it was never really there. Here's the worst part. In order to pay the tax, you're going to have to sell something, sell an asset or sell that private equity in order to pay the tax. It's going to cause massive selling pressure. In just a very simple example, I know they're talking about for high net worth people. Folks, who do you think creates the jobs? It'll crush Silicon Valley. Silicon Valley's private equity. If all these private equity guys got to ante up as you go when they've got phantom gains, but the deal's not really done yet or closed, it's when you have a willing buyer and a willing seller that sets the real price. That's how you can tell whether it's truly a fair value, not some arbitrary valuation they're setting, because you're not really sure until it's not a bird in the hand, right? And so if you if we start doing that and taxing on unrealized gains, it will absolutely kill growth. You won't have the Amazons, the Microsofts, the Teslas, the biotechs, none of it. And you will absolutely...
No mention of a tax credit on unrealized losses, right, Dan?
I did not see that, Don. I missed that part. That must be in the
Imagine
bottom.
that.
That must be in the bottom of the bill. Well, listen, Don, you're not going to have to worry about taxes on unrealized gains, because if this starts coming to fruition, people start selling ahead of it, you'll have a massive washout. Folks, trust me, it's a horrible, horrible idea. Anyway, I do want to talk about that, but they are all in the show notes. I've got a few other articles. So we got the T-bill and chill. What are you going to do when the yields come down, right? Then I've got, on a related topic, how to help clients navigate before rate cuts. I've been talking about that for a few months now. I've already told you how to do it. I wish they'd listened to us earlier so you get better, quicker news. The charm for the 45% capital gains rate, that's the one I was talking about. And if you don't feel good enough about being screwed by Wall Street, institutional money pays half the price for muni bond trades as retail investors. That shouldn't surprise you. So you really have to know how to buy individual bonds so you don't get screwed. If you need help buying individual bonds, call me. I know a little something about it. And does the Biden-Harris wealth tax have legs? That's what I talked about. I hope it's DOA, dead on arrival, because if it gets passed, our economy will be DOA. All right. I want to get right into the markets, but first, I want to hit the mailbag and set this up. First, I'll go on this. 828. This is from MB. This is article, Yahoo Finance, why Kamala's approach to capital gains is generating so much controversy. I said, yes, I already saw this, have similar articles too, but will be a topic on the show because of its sheer madness and job killing and growth killing policy. Who is the arbiter of valuations? I got a little political here. Judge Aragon, who believes Mar-a-Lago's worth only $17 million. Folks, Mar-a-Lago's at least $500 million, at least. So he was way off. And that's who you're going to have. That's what I'm saying. Forget about the judge. Regulators, people that work behind a debt, they're going to decide what your value is, what you're going to pay tax on. I mean, they could be punitive if they wanted to. How do you know? You're going to have to get appraisals every year. You know the cost on this? It's just crazy. Anyway, what if they overvalue for tax purposes? Why? This is why a willing buyer and a willing seller is actually used to determine the fair value and what a person would actually pay. Otherwise, you will have forced sales putting downward pressure on the economy and asset prices. And this is MB's reply. And by the way, I know this guy. He's actually a very smart CPA. He said, the government should keep its hands off the free market economy. Willing buyers and sellers is the only way to establish value. Me comment, huge problem. It can be implemented punitively and without discretion. That's one of the problems I had. All right. These other two. This one is Don on your night. This is JW 828 also. Don on your nightly video updates. Monday you mentioned pay attention to the first 30-minute range on SPY. If it's below, it's closed. The bears are in control. If it's above, it's closed. The bulls are in charge. Is it the high or low of the range for the first 30-minute candle, or the high or low price of the 30-minute candle? Thank you, JW. John said, follow the charts. This is my comment. Follow the charts, Don, of few words. Not understanding your question, they are the same thing. So what Don is saying is the high and low of the candle is the high and low of the price. So when you're seeing those candles, those are the prices, the top and the bottom of the candle. That's the actual range. The range is the candle. If you got any questions, just reach out to us. All right, one more. Also, this is MB in the rear view mirror. He sent me another article because everybody's talking about NVIDIA, and this is what we're going to tee up because NVIDIA came and actually had earnings yesterday, and that's the big mover. In the rear view mirror, holding NVIDIA through its ups and downs paid off a total return of more than 500,000% since its company's IPO in 1999. But the 83% fall in 2002, the 76% pullback in 08, and the 50% slump in 2022 would have tested the faith of most investors. Me. He's sending me this article, and you've seen the articles. If you started with Amazon $10,000, you'd be worth $34,000 today. Here's the problem with that thinking. Okay, me. Pullback of negative 76% and negative 50%. Really, a pullback? That's decimation, and nobody holds through that unless they got lucky or simply forgot. They threw the stock in the drawer. Everybody I know that has that little bit of stock from IPO that if you had it in the drawer for $10,000, now it's worth $1 million. Everybody I've talked to that ever done that simply forgot they had the stock. They did not hold it. Amazon almost went bankrupt 3 times and went down more than 98% 3 times. So here's what I said. Only a few stocks out of the 5K universe do this. The rest are mediocre. And it doesn't even count the thousands that went bankrupt. So you have to pick the exact stock or the right 4 or 5 stocks out of 5,000 plus another thousands that went bankrupt, then hold through 70, 80, 90% drawdown. That's how you get that massive, massive return they're talking about. Folks, remember when Amazon first came out, it was selling books online. Nobody thought it was going to be this massive retail seller. When NVIDIA came on the scene, it was kind of a cool new little pissant startup that that made the chips, but everybody was laughing, saying that's going to compete against Intel. You didn't have clues at the beginning that they were going to be well managed, miss a bunch of landmines, and we're going to be the 1 or 2 or 3 very lucky few. Think about it. Of the 5,000 stocks in the market, or 4, whatever, there's only 4, 5, or 6, or 8 true huge mega leaders like Microsoft, Apple, and NVIDIA out of all those stocks. So when they do this, they are backward looking. That's a lot easier said than done. I can read the left side of the chart easy. It's reading the right side of the chart. Show me someone like that, and I'm impressed. Now, Don's answer. I like this. Don of Follow the Chart, a few words, says, hindsight's always 20/20. I like my answer better. Anyway, so with that, I want to go directly into markets now. You can look at all those newsletters. Folks, we do the full service planning. If you need estate planning, retirement planning, asset protection, corporate structure, I've got a very strong finance and accounting background. We do all that stuff. It's just kind of boring, and people really, and so we do that customized planning one-on-one. But for the markets, it's how much risk is in the market, the sector, the stock itself, and it's the market's time frame. So we care about the market risk and the market's time frame, so we can dovetail our strategy, and hopefully your strategy. If you have your money with Revere, then we're going to talk about exactly what we're doing with your money. And if you're not a client of Revere, this is what you could be doing with your money. So, Don, I set you up pretty good, man. Don't let me down.
Don't you always, Dan?
I always. Hey, by the way, I forgot. Don said back, I was doing that little song, Turn Out the Lights, the Party's Over. Right before we started the theme, Don said, oh, we're back in black. AC/DC, because we all got our black shirts on today. That was not planned, folks. That was just fortunate. Anyway, go ahead, Don.
Hopefully we don't have a Black Friday or a Black Monday in the market. Obviously, we don't. So where are we?
If we do, we have a plan, Don. If we do, we have a plan.
Always have a plan. Maximum downside right now is a little more than 4.5%. For Revere clients.
That's if rebar gets hit. Revere estimated balance at risk.
Revere estimated balance at risk. That's correct. That's if all of our stops for all of our positions get taken out, and that would include a a holding on to a piece of our core position, that's the S&P 500, all the way down to the 200-day moving average. So we have various levels of exposure depending on where the markets are relative to their moving averages and the strength or weakness of leading stocks. So let's go back to 7/11, July 11th. That was the date that a CPI report came out, and it showed that inflation, that kind of broke the market took it to mean that the back of inflation had been broken. And what we saw there was a big move up, a big rotation out of mega cap tech, out of the NASDAQ 100 and into small and medium cap stocks, and also beginning of the outperformance for financials. You can see on this chart here a big, ugly negative reversal off the top that day for the NASDAQ 100. That is the day that the relative strength for the NASDAQ 100 peaked. I'm going to point out the pluses and the minuses that we're seeing in the market right now. So that was the date that the relative strength in the NASDAQ 100 peaked. Why is that important? Because the NASDAQ is typically the leading index up and down, meaning you're in a bull market, it leads higher because it's tech heavy, and tech is where the innovation and the growth stories are at. And if those stocks are out of favor and it starts leading down, that typically leads the way down. But we're not seeing the market break, but we're seeing the NASDAQ 100 underperform to a fairly significant point. So there's the negative reversal. And this is not a bad looking formation. It's a cup and handle on the NASDAQ 100. And it's very possible that we put in a nice handle and we break higher. And that was one of the working theses that we had in the shop here, depending on the reaction to NVIDIA's earnings. The two most important people to the stock market are one, Jay Powell, and number two, Jensen Huang, the CEO of NVIDIA, because their products are the leading edge of AI, and AI has been leading this rally. And they reported earnings on Wednesday after the bell. And Wednesday after the bell. And the stock has sold off. In fact, it's broken the 50-day and the 21-day moving average. This doesn't mean it's the end of the story for NVIDIA in any way, shape, or form. They've had negative reactions to earnings before. But if you look at a weekly chart, they've had some fantastic moves on fantastic reaction to earnings reports. Now, one of our rules is that we buy and sell. We buy on technicals and fundamentals, but we sell only on technicals. And for us, a key technical is in individual names is the 50-day moving average. It's key for our indexes as well, but more importantly for individual names. And what we're seeing now is a high volume break of NVIDIA this week. By the end of the day, we'll be above average on the weekly volume. But this is also on the back of two heavy volume selling weeks 4 and 5 weeks ago. And it's also, we have to consider that we're in the slowest week of the year. So big volume in this name during the slowest week of the year. Initially, the reaction on Thursday was the NASDAQ 100. Despite the fact that NVIDIA was down, money was flowing into these other FANG type names. But as Connor pointed out in the video, the Thursday video, we had a late swoon in the NASDAQ 100, and that carried the S&P 500 down with it as well. And today, you mentioned that open 30-minute range. We broke the opening 30-minute range to the downside on the NASDAQ 100, and we've also broken it on the S&P 500. Basically, the way we look at things is we monitor the opening 30-minute range. If you break above it, bulls are in charge. If you break below it, bears are in charge. Yesterday, we actually saw both. We saw a break to the upside initially before that late day sell-off. So the bulls temporarily took charge, but then we sold off late afternoon. Today, by late morning, the bears have taken charge by breaking that opening 30-minute range. So this looks fine. I mentioned that the chart looks fine on the S&P, on the NASDAQ 100. On the S&P 500, all we are is in a 6-day consolidation. The key levels, 2 key levels here. To the upside, 56.52. That's acting as resistance. To the downside, very important support level, 55.60 to 55.66. This was also the level before we broke down out of that big 3-day sell-off back at the beginning of August. 55.66 was where we reversed there as well. So price does have memory, and the S&P 500, you do not want to see it break below that 55.60 level. On the NASDAQ 100, we do not want to see a break below the low of 4 days ago, which put in the recent low. That was 467.89. So those up and down numbers on the S&P 500, 55.60 to the downside, 56.52 would be a breakout to the upside. To the downside, the NASDAQ 100, 467.89 is the big support level. We're hanging between the 50-day moving average and the 21-day moving average. And the NASDAQ 100 is the only index where the slopes, where the moving averages aren't properly configured. Normally, we want to see the 8-day moving average above the 21-day moving average. We want to see that above the 50-day moving average, that above the 100, the 150, and the 200-day moving average. And when price is above there, we are bulls. Plain and simple, we're bulls. We're not also this week, we're not seeing much progress in leading names. 3 of the 21 over 21 leaders list have broken below their 21, of course, headlined by NVIDIA, which had that break. The inability to get back above it and stay above it yesterday and also today is a big red flag for the market, because this has been the leading stock in the market. Notice it's been making lower highs, both on price, also lower highs on a relative strength basis. And now we broke this key level to the downside. We rallied up to it now yesterday and today and failed. So what was support is now acting like it's flipped to resistance on NVIDIA, and that's around the 120 level. We sold our NVIDIA position in non-taxable accounts yesterday. We hedged for taxable accounts that have pretty big gains that we're waiting them to become long-term gains. Some are, some aren't. But we're hedging if basically we're below the 50-day moving average and below that 120 level. So that's the outlook on the market from a big cap standpoint. Let's look to small caps now. These have been showing relative strength over the last 2 weeks. And again, that coincides with last Friday, Jerome Powell in his Jackson Hole speech kind of laid the groundwork that they will be cutting rates later in September. I think it's the 3rd week in September when the FOMC meets, and the market is pricing in at least a 25 basis point cut, possibly a 50 basis cut, 50 basis point cut, and looking over the next few months, 100 basis points in cuts are being priced in. That's normally advantageous to small caps, and we have seen, first of all, with the CPI report, money flow into mid and small caps, but that was countered by this big 3-day panic that we saw, where there were multiple geopolitical and financial situations that came together to roil the markets. The market recovered from that. We had a breakout last Friday on the NASDAQ 100, on the small cap index, and it's holding. It's flagging very nicely sideways, and it's showing relative strength. And we do have a position in the small cap indexes via URTY or TNA, which are leveraged indexes long the small cap indexes. So the things we're monitoring, and every night in the videos, we have keys that we're watching for the prior day and how they played out, and the keys that we're looking for the next day's session. So in tonight's video, I'll talk about what the keys that we'll be watching for on Monday, and I'll be talking about these levels. Is the IWM going to hold its breakout? Is the NASDAQ 100 going to hold its lows? And what happens with the trading range that the S&P 500 is in? You don't have to predict. We just go by what the market is actually telling us, And then along with that index action, we'll look at what is happening with leading stocks. Leading stocks have kind of paused this week, with the exception of Ferrari. Obviously, there's not a recession in
Racing.
extremely highly priced cars. I mean, this, and we have a position in this. We actually sold some into strength, and it continued to go higher. We sold some when it got 4 ATR extended, and it keeps riding that 4 ATR level higher. Great relative strength. This is the leading stock in the 21 that we own. It's not a market leading stock because it only trades about 110 million daily dollar volume. It's just not big enough to power the indexes. It's an 89 billion market cap. Compare that to, the likes of Apple. That's, $3.5 trillion market cap. But I mean, it is a leader, but it's a small leader. If they were all acting like that, we would be much more bullish on the market. But most of them are acting kind of like this is CPNG. This is a Korean internet retailer, tried to break out, had a good reaction to earnings, tried to break higher a week and a half ago, and now it's breaking the 21-day moving average. So we're seeing a few of these. That's to the downside. We're also seeing a few just kind of go sideways, like ServiceNow, not really making any progress, not doing anything wrong. But here was a breakout on its earnings report. It had a violent shakeout. It's trying to work its way higher, but when it gets to the top of the base, it pulls back. Tried to break out again yesterday, went to the top of the base and pulled back, having an inside day today. Relative strength, really nothing to write home about. It's been lagging since for where it closed on that high volume close when he had its earnings day higher. So most of them, most leaders holding up okay. On our trend gauge Wednesday, and I'll bring this into the picture, we still got the coveted 4 green arrows, which means leaders looking fine, and we're trending for the most part above the 2150 and 200-day moving averages. That's our short-term, medium-term, and long-term trend. But the NASDAQ 100 has broken or is testing around the 21, and it can't get back above the 50-day moving average. So that, with the lack of follow through in leading names, brought out the 3 yellow sub arrows. So it's kind of green arrow with an asterisk is, I guess, the way you can look at it, with the NASDAQ 100 lagging, and the fact that that is the leading index gives us a little bit of pause. We're on the low side of how allocated we are for clients. We have a rule that we've got to maintain at least a 1.0 beta exposure as long as we're above the 21-day moving average on the S&P 500. We're just a little bit above that. If leaders were acting well, we'd be up closer to 1.4 or 1.5. So there's a lot of caution is what we're seeing in the market. The market's not breaking down. Small caps are outperforming, but the NASDAQ 100 is underperforming. And that's pretty much my take on the market. Dan, you have any questions or follow up on that?
Yeah, baby. Well, yeah, I got a couple questions and a couple comments and a couple kudos. Okay. First of all, you said something that you've probably said this before, and for some reason, you hear something over and over, but just that one time you just hear it right. You said price does have memory. And that's actually a great, and folks, what that really means is it's actually human behavior. It's emotion, like they talk about the Fibonacci numbers, and people say, oh, well, those are just random numbers in nature, whatever. Yeah, but it actually, you can find levels. I mean, people's behavior, whether people are reading those Fibonacci and then trading around those, so it's becoming true because they believe it, or whether it's because it's their human nature and it's their feelings and it's creating those lines. It doesn't matter. All I'm saying is price does have memory, and these things you can assign probabilities to them. Regarding race, you said we took profits and it kept going up. Folks, nobody ever died broke taking profits early. So a lot of times you want to aggressively take profits. When you talked about that moving average stack, folks, when he's talking about the 8 above the 21, above the 34, above the 50, above the 200, that's a moving average stack. That means if they're sequentially in line, that's a healthy sign, and the NASDAQ wasn't. The one question I did want to ask you, Don, so when you had that little screen up, that little the long-term, short-term, and mid-term, and they're all green, but you had the little yellow arrows, like your antenna are kind of coming up, so it's starting to get a little soft. Does that mean that you may hold off on as being aggressive buying, or what is what do you use? I mean, how does the yellow arrow help you? Just let you know
It
that you could get a
definitely.
change?
Yeah, well, the yellow arrow goes on here because of what we're seeing in the positions that we have and in the what we're seeing in the action of the indexes.
Go ahead.
So really what happens is during the day, we will see negative action that will lead us to reduce some of our exposure. And then the yellow arrows come on when we do the report at night.
Okay.
Then you go to the next day, you know where you are. We'll see what is the 30-minute range on the indexes. Are we holding it? Are we breaking to the upside? Are we failing to the downside? And then you just repeat the whole process the next day. If we break the 30-minute to the upside, we'll take a look at individual names. If they're at low risk entry points, we'll consider putting some action on. At the same time, we're looking at what sectors are leading on the day. Is tech leading? Are small caps leading? Are financials leading? And that leads us to the individual names that we want to put in the portfolio.
Right. Okay. So now I got a comment or more a question for you, the listener. If you're not a client of Revere, why? No, seriously though, is your advisor following the markets this closely? Is your advisor putting out a video? So what Don just showed you, he actually does every night. We have a daily market insight video where someone on our team puts out a video at night showing you the short-term, long-term, and mid-term NASDAQ, small cap, all the different indices, and then actually what we're doing in our own portfolios, getting more aggressive, getting less aggressive. We're constantly showing you very transparently what we're doing. But the question I have is your advisor truly a market technician watching all these things? If you ask him, hey, where's your stop at? Or what key levels are you watching? Or is he taking you to lunch and playing golf? I don't know. That's a question. In any event, I'm just throwing it out there. Folks, we actually have a very special guest today. We've got he actually works for Revere. He's a consultant. It's Alex the Greek, and he is actually not only a stock specialist, but he's also in options. He's very good. He's a professional trader. So, Alex, how are you, mon frere?
I'm doing good. I'm getting ready for Choptober, I call it, instead of September, October. Choptober, because the markets get a little volatile during this time of the year, seasonality.
Oh, yeah, I'm sure it'll get a little bit. By the way, before we go on to Alex, I did want to make one prediction because Don was talking about 25 basis points or 50 basis points in September. Folks, I'm going to say it's going to be a 50-point drop because it's an election year, and they want to grease the wheels for all the incumbents. They like the incumbents. The Fed, they do. They don't want anybody running a campaign against them saying they're doing the wrong thing. Now, it may be a 50 basis point in September, or they may do a surprise cut and catch everybody with their pants down, so it really, really has bigger effect. In any event, sorry, Alex, go ahead.
No, you're good. I'm going to go over 4 longs today, and then one that looks pretty bad, short side. The first long is LMT, Lockheed Martin. So, as you know, with the turmoil in the Middle East and Ukraine, they're going to benefit from that. Unfortunately, it's just the nature of war. They build all the planes and the technologies. I don't know the exact details of what they do, but I do know that they're making I think they make the F-35 and the F-16s, if I'm not mistaken. So that chart is looking pretty strong and has been riding the ADMA higher. I like the look of this. The other one is NOC.
Hey, Alex, real quick before you go on. So we've got a few engineers. In fact, one of our clients is he's one of the lead engineers on the F-35 line. It's on the plant is on the west side of Fort Worth, and if you go drive on that 35 west side and you drive past there, you see these planes flying all the time. It's pretty cool. You can go out there.
I think the F-22s fly over here in Arizona. I see them sometimes.
But he won't. Obviously, he's got a very high security clearance.
Yeah, there's only so much they can share, right?
Yep.
The other one is NOC. That's telling the story too that I don't see them really, unless some kind of peace talks happen or the election happens. I don't know. But right now, these stocks are in play. I think the ETF is DFEN, which Don has talked about in the past on shows and on the nightly videos. And I think those are comprised into that ETF. So the next name was a gap up name. It was PANW, Software Security, Cybersecurity. So Palo Alto had this gap up and actually came back down, but is U-turning off that 8 and looks really good. And the volume powders are showing some institutional support. I think that some of the money from CrowdStrike has rotated over into Palo Alto. That's sometimes how I would assume institutions play with their portfolios. If they have to stay invested, mutual funds have to keep a certain benchmark.
Right.
Invest it. The first place I would go is to Palo Alto. It's the most liquid and it's the near highs. So that's, I think, a combination of the good earnings report and that is the CrowdStrike. Everyone knows what happened with that. The entire day, a lot of different companies got affected by their failure.
The government too. Don't forget the government,
Yeah.
Alex.
Yeah, and
They
I think
just
airlines got affected.
The government just got 200. Pretty much the entire American population, their Social Security's got hacked. So,
oh my gosh,
the government needs some help.
The last one I have, long-wise, that looks pretty good is Uber. Now, this one's been kind of stubborn and seems to be stuck at this range between, I would say, $70 to $74-ish dollars. You can see pattern rec here is picking up a double bottom base. That's a pretty long base, and we know how that works. If the long base ends up working out, the space higher is bigger. The longer the base, the bigger the space. So that has worked in the past. We'll see. Like Don said, with the indexes handling out and consolidating, if they start to turn, these are the type of names that I'll target. You need the wind at your back. You need the indexes to go for your leaders to work. It very rarely does that name go and the indexes go down like that. I've never really seen that actually. So let's hope that the index.
Alex, where would you on this chart here, if the indices did cooperate in continuing moving higher, and so Uber was acting well, where would you buy it here? Where would you? You're trying to break through that resistance right there at? I guess it's kind of 75.
You could stagger in. It doesn't have to be all in one. You could put a piece on, and then if it gives you positive feedback, you put another piece on at that high around that 74 area. Yeah. And if it starts to really tear up and you see volume, you can go to a full size position right above that. So I would say not one spot, like stagger in and one piece at a time. I know Don has done that in the past with leaders. He doesn't just go hammer it in one buy. You got to get feedback first. So I'd say around that range.
So you're doing a starter position, then you're legging in, and then once you get confirmation, then you take the bigger.
Oh yeah,
size.
And you know when you're right.
Yeah.
It happens fast. Like you're like, okay, look at the volume, and then you pull up an entry chart, and it just looks like a green tower. Like,
well, folks,
that's all you need.
Folks, he's making a great point. So when we're saying that, we're not talking about adding that position over 3 weeks, like you buy it, then it happens 4 days later, and then it happens another week later. When we're talking about this, if this happens and it continues, because we're looking at we're trying to find stocks that have the highest probability or a very high probability of moving higher in the short term. So if it does work out, we will get those 3 trades all within short order, pretty close together, normally within a few days. So, by the way, when you buy stocks, if it doesn't work out, you will know normally, not all, you will know very quickly right away, and that stock may get sold the next day or the next few days. So the stocks that don't work out, they normally get sold very quickly within the first week. It's the stocks that work out that start holding that you'll actually hold longer. All right, Alex, go ahead. And
one more point I want to make, because this job's hard. I've had times where I've bought the same stock like 4 times. It just kept trying. It was stubborn, wouldn't work, come back down, wouldn't work, come back down. But I didn't give up on it because it didn't really do anything wrong. And then it ends up working. So just because the first trade didn't work doesn't mean you can't give it another shot. So it doesn't mean you have to put it away and put it, oh, it's not on my watch list anymore, I didn't make money on it. No, keep watching it because it might actually end up being the leader. I've made that mistake before where I stopped watching and then the stock ended up going on a run and I was locked out. All right, so
classic behavioral finance. When you get burned once or twice on the same stock, you get a bias to that stock, and you don't want to do it.
The last one we talked about on the show, I think the guys talked about this show like in March, was on SMCI. Mm-hmm. So a few days ago, it started to really break down. This is looking really ugly, and this is a classic example of a TML, and then going into a stage 4 down cycle. This looks like it wants to go back to that base all way on the left side around 250. It looks awful. And that big volume down on the right, that big red bar, there's people cleaning out. They're getting out, and they're rushing to get out. And you know the saying,
that's institutional money.
Elevator, elevator shaft down. And that's showing elevator shaft down. So, look at all the moving averages sloping down too. It works both ways. You want the averages working with you on the way up. If a stock's on the way down and you're short, you want those averages sloping down, and it helps with wind at your back that you're right with the momentum.
Okay, so Alex, tell us how if you were going to short. And by the way, there's a lot of learning here, right here, folks. So SMCI was a TML means true market leader. It's one of the leading stocks. In fact, Teddy Bull actually got this last year, and it was a big home run for him. Right, got fortunate, picked it off at the right time. He was watching it. But leading stocks fall on average when they really blow up 72% from the top in 2022.
Yep.
After Tesla being the leading stock in 2021, it was down 69%. So, but Alex, so if you were going to take a short, I want you to tell us, kind of walk us through how you would take that short, like what you'd be looking for and where you would actually do it. And then also describe how you would buy a put. If you
so the perfect scenario, so there's multiple ways, but the perfect scenario, which I missed, was when it backed up into the 21-day, like a week and a half ago. You see how it curled back up and it paused.
Yep.
That's where I'd be looking. Now, I don't know how the shares are offered at certain brokerages if you could actually short the stock and how liquid it is, but the options are there. I would look at the same way I look at the calls. Couple months out. Keep the strike within, 5 to 10% range. Make sure the open interest is there and there's some volume. They're pretty expensive, and there's a reason why the implied volatility is high. So the market makers are pricing in this thing wants to move. It can move $100 in one day. Right. We saw that 2 days ago. The thing just plummeted. So I prefer using puts because you don't have to put as much money up front, especially. The stock's $430. I don't know if I'm shorting 100 shares. That's like, over 40 grand. Like,
right.
I'd rather just do puts and not put as much money out there. So that's the way I would do it.
Right. Okay.
So you're looking for a couple, like digestion. It's the same way it works the upside. Consolidations end up going in certain direction, either up or down. They don't stay in the same pattern for long. They end up, like
breaking out or breaking down. Yeah.
Yes.
So he's talking about that sideways pattern that where Don has that line drawn. You've got that consolidation sideways. After it consolidates long enough, it's going to break out one way or the other. Now, here's a very valid point. You don't want to pay for extra time premium or things you don't need for options. So if you've got a longer term outlook and you're say you're very bullish on a particular stock, you may do a leap that's 1 year or you need 6 months to buy it. In this particular situation, when you see a stock breaking down, folks, the market sells off a lot faster. It goes down a lot faster than it goes up. They always say on Wall Street, it's an escalator up and an elevator down. So you don't want to go buy a 6 month or 8 month put on this because if it breaks down, it's going to happen quick. It's going to happen in the next few weeks or month. You don't need that extra premium for the extra 6 months. All you need is the next month or two for this particular strategy. So it depends on what you're doing to match the right maturity date and strike with the strategy and for what you're trying to do. Both long and short.
Dan, I have one last thing.
Good.
Don, if you could pull up an hourly chart on this, I just want to show the technical junkies something they may like. So you see on the right side right there, it's a little bit different on MarketSmith compared to mine, but it's actually setting up an H pattern here, which is really bearish. So this little see that little on the way right, Don, that upside down bowl. Yes, that's a big that's a big H pattern. There's another H pattern to the right, so there's two H patterns. That's bearish. So my suspicion is that this thing probably wants to go lower. Right. Yeah, see how you drew that line? That would be the breakout area. It's the opposite of the bullish setup. It's the bear setup.
And I'll tell you, with the put, all you're doing is you're buying you're paying for the premium. So even if you bought a put for a couple $1,000, that's the most you could ever lose. You can't lose more if you buy the option. You can't lose more than you invested. So it's very easy way to manage risk. And you don't have to be exact, with the short, you got to borrow the shares. You're paying 11, 12% margin.
There's a lot more risk.
Oh, you got to be more right than the interest you're paying for borrowing the stock. And the higher volatility stocks like this will have a much higher interest rate when you borrow the shares. So anyway.
That's all I got today, guys.
All right, Alex, that was awesome. Like drinking out of a fire hose. Good.
Something I want to point out on this, and I mentioned this earlier, and this goes to this stock as well. We buy and sell on technicals and fundamentals, but we sell only on technicals because the fundamentals will always look best at the top. Look at the fundamentals on this company. They earned $11 in 2023, $22 the next year, $34 the next year. They're slated in 25-26 to earn $44. The fundamentals are still fine. A lot of people say, I don't ever sell a stock until my fundamental thesis change. Well, that's great because you're now down 60% from the highs on this just from March. The whole time, the fundamentals are continuing to improve. You only get paid on price. You don't get paid on the fact that they're still showing accelerating earnings. And also this week, a big short report came out on them, saying that there's some possibility of accounting fraud. 2 days later, they delayed their annual report. And that's why the stock has gotten absolutely crushed this week, down 30% this week alone.
And one other thing. So it's also not always that the number is increasing positively like earnings. It's the rate of change of the number. So just because the earnings increased, if the growth rate of earnings is only 50%, but last year it was 100%, even though it's still gone up and it's gone up by 50%, people were looking at 100% and now they're disappointed. So it's not that you just beat the number. It's really the expectations and the rate of change. It's almost always the change of whatever you're measuring. Just like when Don's looking at relative strength, it's the rate of change of the slope of that line. How fast is that relative strength rolling over and becoming a negative slope? Or if the relative strength is negative, is it flattening out going horizontal? That means selling is abating and it may be reversing higher. So you really want to pay attention to these. All right, Don, you got anything else?
Let me point out, Alex mentioned Uber. We do have a position in Uber, and he talked about the way we pyramid and demand positive feedback on our stocks. Uber, the chart looked frankly terrible until their last earnings report. The earnings report was very well received. It gapped up on earnings on nice volume and then continued higher and reclaimed the moving averages that we always want to look for. We initiated a quarter position here on this break above this little 3-day low volume consolidation. We added more after a 2-day consolidation on here, but then it stalled. And our second buy went negative, coinciding with this breaking the 8-day moving average. Now, we like Uber as a company, but we're seeing too much action like this in leading stocks. Once that second buy broke the 8 EMA, it rolled over and we went negative on that second buy. We sold the second buy. We're still holding on to the first buy because it's positive and is staying in line with the performance of the S&P 500 since that second buy. But that's a little insight into the way we handle pyramiding both to the upside and the downside.
And you do it with sensitivity to tax. I mean, It's very intricate and it's very detailed, folks. Again, the question is your advisor doing this? Or is he just shaking your hand and playing golf? Let's go hit the back nine.
Or putting you in a pie chart with 59 different mutual funds.
Oh, Don's got a little burr under his saddle. We got a new client that came in with 59 different mutual funds over at Fidelity. In fact, he had 9 or 10 or 11 emerging market funds, all different emerging market stocks. I mean, index. It's the same index. It's like buying 10 S&P 500 funds, the same fund, the Vanguard S&P, the Schwab S&P, and the Fidelity S&P. Folks, you only need one. Right? Now, sometimes we'll use a SPLG and S&P fund, and then we'll buy a tripler leverage for that second buy, and then we can buy and sell that one. But you got to do it. You don't need 50 mutual. If you have 50 mutual funds, fire your advisor now. Seriously, that is the illusion of diversification. You're way over diversified. Remember, there are more mutual funds than there are stocks to put in them. Let me repeat that. There are more mutual funds than there are stocks to put in them. That means if you got a large cap growth fund, you got 4 of them, guess what? You own the same stock 4 times. Go look at their top 10 holdings. Go look at the overlap. Okay? You want a couple ETF. Look, if you're trying to get even a diversified pie chart, that guy that came over with 60 plus mutual funds, I showed him mathematically how he could replicate that. I still disagree with it. If you want to do it, you want to do the asset allocation with just 6 to 8 funds, and he's done. He doesn't have to watch 56. Same correlation. But he's still going to have to deal with 30, 35, 40% drawdowns. Why? Because when it hits the fan, all the correlations grow together, and they all go down together, albeit at different rates. So when it hits the fan, you want to cover up. You want to hedge or move to cash. You don't want diversification. You want cash. On the way up, you want just enough diversification so one position like an Enron where they're cooking the books doesn't cream you, right? Just like SMCI. Doesn't matter whether they're really cooking the books or whether it was just a story from a short seller trying to pump and dump. It doesn't matter. The point is the stock's down 50%. Well, if you went big and you went 30% or 20% in that stock, you just got eviscerated if you didn't sell it. So the bigger your position size, the more important you have a sell discipline. We feel it's important anyway. In any event, folks, we hope you enjoyed the show. We hope you have a safe and happy 3-day weekend. And listen, just please tell your friends, tell a neighbor, just send them to revereasset.com. Up in the upper right-hand corner, there is a Contact Us button. That'll send me a direct email, or you can just send it to me, dan@revereasset.com, and it'll send me an email. You can ask about a complimentary portfolio review, a stock or topic you want talked about on this show. And there's a subscribe button. They'll get if you want to subscribe, they'll get this podcast delivered directly into their inbox Saturday morning, and all of our nightly insight videos every day the market's open. But if you subscribe to YouTube, just Revere Asset on YouTube, this podcast, you get it by 1 o'clock Central Time as soon as Zach produces it, because it goes on YouTube a little quicker. So that's for our stock nerd junkies. Folks, have a safe and happy weekend. And also, you can always call us at 855-REAL-WEALTH. We'll talk to you next week on your money, not their money, your money.
It's not about how much you make in the markets. It's about how much you can keep.